Welcome back. 19,610 on the Nifty. Markets are sliding. We're lower by 63 points, down for the fifth consecutive day. IT is under pressure. The Nifty IT index is down 1%, though in the last 1 month it's done well. The Nifty IT index is up close to about 4.5%, and year to date, the Nifty IT index has a gain of nearly 14%. Ankur Rudra, research head of APAC Telecom and India, TMT, that's Telecom, Media and Technology Research at JPMorgan, is here with us from the sidelines of the JPMorgan India Investor Summit 2023. Ankur, morning, and thanks for joining in. First, if you could just give us the feedback on the ground. One, from the companies about the demand environment. How has Q2 shaped up versus Q1? Is it better, similar? And two, even from the investor community towards IT, because IT is held out and it's been quite resilient.
Hey, good morning. Thank you for having us. So, look, we've recently hosted 8 IT services CEOs across Asia Pacific. I think the feedback we've heard from companies is, I think, 2 or 3 things. One, we've heard that demand potentially has bottomed out. It's still not great, but it's sort of stopped worsening incrementally. And within the overall demand perspective, the problem area which continues to persist is financial services. That hasn't really recovered for anyone. But parts of TMT are looking like they're improving. The other point is about we've seen this spate of large vendor consolidation deals coming through. So quite a few large enterprises, probably more on partly in banking, partly in telecom and communications, have sort of begun to give large contracts, which is giving some medium to long-term positives to these companies. But the main problem is that we are not seeing a recovery in discretionary spending for many of these companies. That's the sort of problem area. So Q2, our sense is, based on what we've heard from these companies, is not any significantly better. There's no inflection point per se, but it's not getting worse. You're right. IT services stocks have done rather well, and in the last 1.5 months, and I think there have been 2 or 3 reasons that have driven that. A lot of our investor conversations, including at the conference, are suggesting that there's a lot of investor fatigue with underperformance of IT services over the last 18 to 20 months. And hence, in the near term, investors have decided that in the short term, F24 doesn't matter so much, and the focus has moved to F25 significantly. The second thing we've seen and heard from investors a lot more is that a lot of the IT services companies are probably a bit more late cyclical, and hence signs of better or stabilizing US macroeconomic conditions is something they're looking at, potentially an early indicator of recovering demand. These are things like lower than expected inflation so far in the US, in line or slightly better than expected GDP prints, and generally relatively good numbers from a jobs front. And thirdly, we are also, I think investors are optimistic about the large deals that have come through. And finally, I think some investors compare Indian IT from the Nifty overall or global tech, which have all done better. So I think there is some reasons for investor optimism, despite the fact that the bottom-up feedback from companies is not super positive.
Okay. Ankur, I wanted your sense on the ERD companies, the likes of Tata Elxsi. There are the others as well. They have seen their valuations recede. How are you looking at the valuations there? What's your take on the space?
Sure. So we've seen, in general, if you look at the overall portfolio, of companies across the universe, in IT services, valuations, yes, if you look at the last 2 years, they probably have come off a bit. But in the last 1.5 years, we haven't really seen valuations get impacted so much despite poor performance. In the ER&D space, that subsector, valuations probably have, maybe, improved, let's say, moderated a bit. But also has growth. So growth has also sort of come off quite a bit. I think what we feel about ER&D companies is, yes, they'll probably keep growing faster than IT services overall. But many of these stocks bake in very strong double-digit growth, perhaps in the region of 20% for the next 10 years, which we think perhaps is on the richer side, which is why we remain underweight on the IT services sector and the ER&D services sector as well.
Got it. Ankur, hi. Good afternoon. So, just if one has, with market overall market levels at where they are, one will have to have slightly longer kind of holding time horizons for a bunch of sectors. IT is, at least large cap IT is one area where relative to their own historical valuations, things are not completely out of whack. if one had a 2 to 3 year kind of view, are some of these large cap IT names compelling buys, and what would your preference be there?
Yeah, so I think, what we've seen is investors have taken that view. Like I was saying before, investors have said that, look, F24 probably is a year of transition. And they're looking through near-term, misses or near-term numbers. For example, Q1 was not a great quarter. Q2 doesn't look like it's turning out to be a great quarter. So investors are looking into F25 and 26. However, the reason we remain a bit more underweight on the sector is, I think, 2 or 3 factors. One, for these companies to do well on a 2 to 3 year perspective also, we would need a clear sign of growth recovery. The stocks already bake in double-digit growth, not only for F25, for F26, because valuations have probably come off, yes, in the last 1.5 to 2 years, but they're still sort of at the levels they were pre-COVID or sort of slightly ahead of that. So we need to see performance coming through. We need to see a turning point. Secondly, we don't see a clear, remember, IT services companies are global cyclicals. We haven't seen an overall turn in the technology supply chain. So we haven't seen enterprise hardware companies, the enterprise tech supply chain, enterprise software companies, SaaS companies, cloud companies showing any signs of changes in momentum or enterprise tech spend. And from we'll have to wait, I think, for the next budgeting cycle for F20, let's say CY24, to take a call there. And so from now to then, we just feel that many of these companies will behave along with the macro as opposed to the underlying bottom-up performance.
Ankur, very quickly, while IT is not yet at an inflection point, are we closer to an inflection point? Are you a little less bearish than you were 3 months ago?
Yeah, so I think what we have said and what we increasingly hear is that demand is probably not worsening at an overall portfolio level.
Yes.
So yes, there's reason to be, I think, slightly less, negative. I think that is fair. But unfortunately, that's also sort of to an extent baked into the stocks. So the stocks have done well to an extent to respect that. So from a demand perspective, it may not be getting a lot worse, but I think the visibility of when the inflection point is, does it come in CY23? Does it come in CY24? When does it come in CY24? I think we are still somewhat far away because the market is completely baked in that we are dodging a recession next year. And we are still not clear about, how that enterprise tech spend momentum plays out from here on.
Oh. Very quickly, Ankur, you want to tell us a little bit about Tata Tech? That's the big one everyone's watching from the IT camp in terms of, a new company. How is it different from TCS, Tata Elxsi? What exactly does it do, the business model? Your thoughts on this one?
Sure. So as you know, we can't comment on individual companies, but in general, we think engineering services companies have an interesting medium to long-term, growth momentum. We especially, on the auto ER&D side, we've seen that there's clearly a very strong, sustained demand. There is a lot of demand around improving on the EV supply chain. There's a lot of demand around improving the in-car electronics, which will probably see, a lot of investment. In fact, across manufacturing, autos probably is one segment where there is clear and, very strong intent to spend, which is likely to be a secular trend for the next 5 to 10 years. So I think a lot of the companies in that space will benefit from that.
Okay. All right, Ankur, thank you so much for joining us and giving us your take on the IT space and some of these segments within the IT space as well. We'll do one thing, we'll slip into a break. When we return, we'll discuss market technicals with Jay Thakur of Sharekhan and also discuss his top trading